What is up, traders? Welcome back to our channel, and today we're going to be breaking down part 6 of the futures course here on YouTube. And we're going to be talking about the age-old, most searched topic ever, timing the perfect entries in the market and risk management to keep you in this game for the long run. Now, a key tip is that execution isn't just about entries. Picking out the perfect entry is great, but money is actually made when you get out of trade. So a hugely overlooked factor of execution is actually the exit, which is going to be a huge component of what we're going to be breaking down today. So if you guys are excited about this video, hit that like button, hit that subscribe button, and let's dive right into it on the screens right after this intro. By the end of this video, you're going to understand my go-ahead with execution in terms of entries and exits along with the risk management, what we talk about in terms of revolving risk, and the high probability trade setups you guys saw in the last video. The last video we broke down the footprint. We talked a lot about how the footprint kind of dictates price movement, the strength in buyers versus sellers, and we broke down a decent bit of execution. But today we're going to be breaking down even more of that execution because there is a huge component a lot of people need to understand, and that is going to be exits, right? Exits and entries are both extremely important when it comes down to identifying that high probability, good qualified trade. So, execution, right? What is execution? It's the process of entering and exiting positions according to your plan, right? We want to stress that entries do get a lot of attention in the trading world. Everyone is looking for entries. Everyone's trying to think, oh, how do I get that perfect entry when it comes down to trading? That's what traders think that matters, the only thing that matters to them. A lot of traders think that if they can time their execution in terms of entries, then everything is good to go from there. Now, although that is a huge component of it, the real importance of execution is combining both entries and exits. For example, if you have a great entry but a terrible exit, then you don't capture any edge, you don't capture any profit, you don't capture any trade, because you actually make money when you get out of the trades. Execution is not about being perfect. Trading is never going to be about being perfect. As you can see, the trades on the screen from today, a choppier session, they're anything but perfect, but we're up a decent amount on the day, and that's what we're going to be talking about, comparing a not so perfect day but solid execution versus a pretty solid day, just one trade. Two of these trading days based on the high probability trade setups that we have. So to circle back, right, it's not about perfection. It's about being consistent with your discipline and your rules and being able to churn this over and over again. Execution, realistically, just like anything else when it comes to trading, when you look for setups, when you look for trades, it has to be somewhat robotic, and you just have to go through the motions when you see XYZ pop up. So if you find yourself getting into some solid trades, but you close them too early, maybe because you don't want to handle the risk, or you might see the position rotating around your entry and you just cut it, then it goes, right? You might be in this situation. This is conviction of the trade, and not having a clear defined goal in terms of an exit target and being very flustered in terms of the actual trade. Is it to plan? Did I get my entry right? Where is my exit even? All these questions need to be answered before you even get in the trade, and that flusters a lot of people, so they close trades very early. So I want to dive into the execution based on the high probability setups that we have and that we know so far, which is based on the pullback. That's going to be a huge component of what it is that we're going to be talking about today. So we want to understand where we can pinpoint the actual entry itself, and while we're pinpointing the actual entry itself, we have to understand what's going on in terms of a target basis. For me to be able to enter a trade, I have to be confident not only in the actual entry, but I have to be confident in what the potential of the move looks like, where that exit target is, so I have something to hold on to and keep in mind as we're getting more and more information. So we're also going to be talking about how to manage the trade when you gather new information that comes out, because obviously everything is real time. When you get into a trade, you have XYZ information. As the trade develops, you have new information. What should you do with that new information? We also want to be aware that there is the potential of analysis paralysis, where way too much information starts coming into the market and you start scratching your head, it clouds your judgment. This is where we divide moving stops, scratching, or letting it play out, right? That's the big question. When it comes to moving stops, should we move stops at all? How do we manage these positions? How do we manage these trades? So let's dive right into this. First and foremost, we have to set out the rules. We have to understand and know what it is that we're looking for and looking at. Part one of execution is always going to be, where is the area that I want to trade from, right? Where do I want to trade from? What side of the market should I be trading from? And what is the potential target? Those are the main points of conversation and areas of interest that we have to understand before anything is even done. So this comes from a trading plan. It comes from understanding context in the market. Now, we've talked about context. We've talked about, let's say, the pullback trade. This is the main trade that we've been discussing throughout this course. So if we take a look at the analysis of the chart itself, right, this is the NASDAQ. We're at all-time highs, or very close to all-time highs. We have a lot of new information, but we don't necessarily have a lot of information that creates balances. So what can we do with this, right? Step number one, context. Let's look at the balance areas. Okay, we have a balance top that's developing at 24,550 to 560, and then the balance bottom is somewhere 24,480, let's say. So this is the current balance that we have. If we go through this very quickly, realistically, we can look at this. Okay, bam, there's the balance. We can see that the individual session from the prior day has a developing balance here, so does this, the weekly. What can we do? If we're outside of this area, remember one of the criteria for the pullback is that when we move outside of a developing balance, there's most likely going to be a tougher opportunity for the buyer to try and buy this area. Everyone and their moms is trying to buy this area when you have no volume trying to support it, so that means there could be a mean reversion. Regardless, we have two possible pullback scenarios. If the longs are expected to hold, well, we shouldn't really see 550 break too much. If that does break, then we have to short into that balance. So the pullback is going to be based on the balance. Fantastic. So that's going to be part one, understanding the context and looking at where we are in the market, what's going on. Part two, it's very simply laid out. Where do we actually trade from? Right? We trade from the auction extreme, so I don't want to complicate this. My execution has to be near or around these massive areas that create these balanced tops and balanced bottoms. I don't want to look too deeply into the balances and identify new information. If new information does come out, it's most likely going to be a new all-time high that develops new volume. So I want to be very, very cautious about that. I don't want to be super blinded by things. So if I want to have the highest probability trades, I'm mainly going to be trading from the extremes of the volume profile that creates these balances, right, these auctions. So I have two areas, right, 550 to 560 is going to be one, 480 is going to be another. Anything that is outside of these areas, we're going to rank it a B level or a C level setup, right? So step number one with this execution is actually understanding where are the areas that I want to trade. Now, execution can get a lot more advanced. It can get more in depth when you start developing new balances on the day. You get new order flow information, right? A lot of different things can stack up to give you that kind of next piece of information. Step number two, or I guess three when it comes to execution. What is the entry trigger, right? And what is the potential profit of the move? So I want to understand fully what I need to see when I'm actually getting into the trade and what I expect out of the trade, because that creates our R to R, right? Our risk to reward. It's going to be very important that we have at least some kind of positive risk to reward before entering a trade. For instance, if I'm looking at a level and I say, you know what, I like the short at 24,560 on the NASDAQ futures here on the Z contract. And I say, okay, what's the potential of the move? Let's say there's two scenarios. Scenario number one, okay, I think maybe I can get 500, maybe even down to this 480, which is the bottom band of the distribution, right? So when I look at this and I can say realistically, I don't want to risk, my general stop loss is probably around 17 points. So if I'm risking 17 points for about 50 to 60, the R to R is greater than 3 even. It's about 3 in this case. So that's a trade that I'm willing to take. Now, if I notice there's going to be some kind of information that might stall prices out, and there's some kind of support on the way down, and I can only maybe get 20 points out of it, my R to R is still technically positive in this case, but it's not very high, so it might be a trade that I rank B or maybe not even take. The ideal is I'm going to be taking trades with at least 1.5 R to R, ideally 2 for the max potential to move. So the next question becomes, okay, even before we get into the triggers, even before we get into the entries, because everyone's salivating, they're like, entry, 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 entry. How do I get in? Where do I get in? What's the trigger? That's great, right? It's very important. But I want to be aware of what the target potential of the move is for it to make sense, right? The easiest way that we can look at targets in this market is going to be based on auctions, right? So where are the auction extremes in this market? So if I'm trying to get from one auction area, I'm trying to look at that as the entry. Realistically, I can look at the individual days, the weekly profile, and the larger profile for the main targets. The main major target for the downside, if we move into this and we say, okay, we want to short 560 on the NASDAQ, the main target is going to be around 480, right? 480 is the bottom band of this balance. There's also a developing balance at 510. So that means I have 2 main targets based on these balances and these distributions. I can look at the weekly and see where the volume drops off aggressively. I can say around 510. So I'm getting around, let's say, 50 or 40 to 50 points initial potential if I'm shorting 560. So that would make sense. If I'm using a 15, even 20 point stop, I think this is good to go. It makes sense. The other way we look at targets, right, is going to be based on delta and order flow, because those are going to be the most immediate market participants that have created some kind of imbalance in the market that's going to dictate where prices are most likely going to stall out. So on the day itself, right, if we don't have the information, for example, this is a delta profile for the current RTH. What I'm going to be using is I'm going to be using the prior ETH, the most immediate ETH delta profile, along with the prior RTH in terms of delta areas that haven't been traded. So I'm looking for major clusters. So if I'm looking for the acceptance, then shorting into these areas, my main target is probably going to be the absorption from the overnight that happened in and around that 515, 520. You have this massive positive block which has the expectancy from the last RTH in and around 500. So 500 to 520, I have a massive cluster of delta that is telling me prices are most likely going to try and hold things out at these points, and they're most likely going to try to reject at these points. So I want to add that into the potential target of the move. So again, I'm not just blinded by, oh my God, I have 480 down below. I need to target 480 because if I short 550 and it comes down into 500, I'm not taking any profit. Well, what happens at that case? It bounces up and then maybe I close it for like 5 points. That's really going to suck. The other factor in terms of order flow that we want to dive into is going to be based on the footprint, right? The footprint's going to give us areas of massive imbalancing, not only entries that are very important, but they're also going to give us areas where prices are deliberately going to stall out based on most recent information. So if we have a bunch of, let's say, people that are getting absorbed and passive buyers into this area, and I say, you know what, I want to short these guys. Well, I need to understand that this is going to be a harder spot to break. So seeing some slight movement under it may be possible, but that's going to be a general target. Extensions from most recent massive areas of imbalance that come from the footprint. For example, this was from yesterday at 500. It's going to be a major target, especially if it's a buy-side move that supports the accumulation to the upside. You can see this is the low of day where they get absorbed, right? So these things are very important to note. Now, for the thing that everyone salivates over, entries. Entries on pullbacks or just entries in general when you talk about execution, for me, is very heavily based on imbalances. The whole idea of this strategy is finding where traders are imbalanced, where there's a massive differentiation in buy and sell side to create those imbalances that are holding, which would consequently trigger the move. So for instance, I want to notice, like we talked about in the footprint, how prices develop. So if we're going to the downside and we're breaking our 560 distribution area, 550, and we're accepting below, right? If I notice there's a lot of selling that actually creates the move lower, I'm looking at the sellers that have created that move lower, and I want to see if prices come back into those areas and reject and create heavier sell side. For instance here, for instance here, for instance here. So if I look at where those areas are exactly, I know that the sellers generally came in from 555 to 560. So overall, about a 5-point area is probably going to be my best entry. So I know that the sellers are here somewhere from the way lower. So when I see a rejection like this in large sell, I don't necessarily want to just put limit and say, okay, boom, at the imbalance. I'm looking at where that move started. So I can set limits over here. I can wait for these sellers to come in, and then I can set limits into these areas within like maybe a 3 to 5 point area on the NASDAQ. So what am I looking for? If I'm looking for the sell side, I'm looking for a large negative delta that holds, and then the second test of that large negative delta to actually hold, and then I'll pull the trigger. So for instance, right, if I see prices coming back into the prior area of all that sell side, and we have a huge negative delta that rejects, I can put my limits to sell this here. I can wait for more confirmation. These guys reject. I can put my limits to sell over here, right, and see if we can get that momentum move to the downside. It's the same thing if I'm trying to buy, right? I'll talk about the longs that I had today. So these longs were B-level setups. They're based on order flow. Why? We have a lot of support from the prior day. You saw all that delta that was shaping up. And what I'm looking for is prices to stop making lower lows. So it's not like, bam, okay, these guys get trapped and there's a bunch of buy side. Let me pull the trigger. That's a good criteria here in and around that 512. Honestly, I liked it. It made sense because you have negative delta gets pushed to the upside, pulls back, positive delta gets pushed up to the upside with negative delta. This would qualify a trigger, meaning you have the initial move, you have the second test that confirms. That second test is the area where I want to set my limits out around 510 for that B level setup to see if we get the push higher. If I'm looking at NASDAQ, the bigger the imbalance is, the better. For instance, when you see 350 and a bunch of positive delta and the reaction is to the upside, this is where you have a huge potential to see a bottoming out in prices because these are massive orders. Anything above 150 on the delta on this chart on the NASDAQ is something very significant that should be watched very carefully. So these guys over here, I'm looking at them and thinking we can look for that long, right? But again, what is the issue with all this? We have lower highs, so I want to think not only, okay, let me get long and then my target's going to be 650. Why would it be 650 when I understand that the sell side pressure comes in from 545 and even above we have 555? So if I'm getting long 512, my potential is probably 542, 3 maybe, right? So I'm looking for about 30 points. If I'm using about a 17-point stop, it's nearly 2-to-1 RR. This is a trade I like, even though it's a B-level setup, because I have to know what the target is. Because as soon as we come back into this area, what happens is that you have huge absorption that gets rejected by these sellers. So they're telling you, hey, this is where you should probably get the hell out because this is most likely not going to be a continuation for that upside swing. Right? This is where you need to be taking positions out because that's where the target is met. So what we're doing is combining the entry with the potential target of the move and trying to get out of this position, or at least a majority of this position, before we get too euphoric and start thinking, oh my God, okay, everything is good to go. We're going to the moon from here. This is the bottom. The next 100 points are ours in the market. Blah, 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 right? All of that nonsense is just hopium at that point without getting a good understanding of what the actual target of the move is, because that's a huge factor of importance that a lot of people really miss out on. So when we take a look at yesterday's session in comparison to what we had today, for instance, right? Today we saw some of that movement, but we take a look at yesterday using the U contract. This was the trade, right? We get the acceptance and the creation of a bunch of delta into all-time highs, and this is the trade. A lot better of a move. It's very directional, and it's less choppy of a day, but the criteria stay the same. what are we looking for, right? Number one, we'd be looking for auctions, but realistically, auctions in this market into all-time highs, they weren't really super developed, right? We were developing this P-shaped balanced bottom, so that's the only information we had. We like that. The other development is going to be based on what's going on with the delta. So there's a lot of absorption in this area. What is the target of this move? Because if I'm getting long into these areas and we're at all-time highs, what's the target? The target's a new high, right? So I can look at it as a 2-to-1, 3-to-1, and try to get that kind of momentum move and then have runners do whatever they want, right? I want to obviously see if there's any kind of information here, because if my entry is 247 and then the top is about 267, let's say, I only have 20 points. So am I willing to risk like 17 for 20? I don't know. But am I willing to risk 13 for 20? Yes, that's where revolving risks comes into play, and we're going to be talking about that as well. So let's take a look at this execution, and then we'll dive into some of the other factors that are extremely important for execution itself. So as we come into these areas, right, what's going on? We have a momentum move that drives prices higher, right? We have a bunch of imbalancing, and then we have all this selling, and everyone's like, it's over, it's so over, and then they get pushed aside, right? Every time we pull down, we get a huge seller that seems a little trapped. But the key here is the big buyer. When I see large significant buyers on NASDAQ or on the S&P like this that really absorb all of the negative delta, that's the trigger. So one trigger push, okay, next time I can try and get into these areas where these guys are confidently holding, right? What's the target? Well, realistically, I'd like to see a new high. So if my position is 24,247 approximately, the high is at 2270, right? I can get maybe 25, 30 points. I can risk 13. I don't have to have that much of a stop on this, which is going to be the next thing that we're talking about. Do I have to be that much under these lows? Maybe not, because these buyers are here. I just have to be somewhere below this candle of buy side, right? So when we talk about risk and risk management, right, these stops and everything, obviously we have to have defined risk per trade, right? This is going to be based on your account. Those are very basic things. You don't want to oversize. Never oversize. Trade based on your account, right? Generally, a rule of thumb that I like to look at is about 7 to 8K of margin per minis, about 1.5 for micros. I generally, right, size based on the risk per trade. So if I'm able to take $500 risk per trade, then that dictates my size based on a certain stop loss, right? Revolving risk. This is a huge theme in my opinion. Revolving risk is the idea that you generally don't have to have the same risk for every trade. And even when you're in trades, you may accept lesser risk than maybe getting stopped out completely, right? So what is revolving risk? Revolving risk is the breakdown of having more malleable risk depending on the trades that you take. Obviously, you have to understand what your daily max loss is, what your weekly max loss is, and go from there. But the idea that certain trades may warrant less size, certain trades may warrant less of a stop loss, certain trades may even warrant just cutting the position before it hits your full stop loss. So when I'm talking about this, right, if I'm getting into a position, I want to understand where, let's say, the immediate resistance is or where the immediate support actually is. And if I hide behind those, it could be that I don't have to take the full max 17, 18, 20 point stop loss of risk. I can maybe drop it down. The other factor about revolving risk is if I'm wrong in a trade, right, and the trade's going against me, and I see that it's pretty freaking close to my stop, let's say like within 5 points, I can opt in to say, you know what, this is probably going to hit my stop. I can save myself those 5 points and get out, rather than looking at this and thinking, oh, okay, let me just go full stop, full take profit, whatever the case may be. I want to keep it a little malleable, but I don't want to keep it so malleable that when I get into trades, I just start cutting trades left, right, and center, right? When I'm in a trade, the thought process is I want to let this trade play out, until I start seeing my first take profit areas, and then from there I can actually start cutting risk and moving stops. Which brings us into a different discussion, moving stops and managing trades. There's a common divide of moving stops, managing trades, getting out at partials, getting out at fulls. So all of that, I think, is a huge discussion that there's different schools of thought, and it really depends on the person, depends on the trader, depends on how they read, view, analyze the market, and what they're comfortable with. For example, let's talk about moving stops to begin with. A lot of people like to move to break even fairly quickly because they want to really tighten the risk and protect whatever profit is being made. They don't want to take a loss on the trade. And I totally understand that. For me, when I move stops, the only way to do that is if I'm taking profits on the position, the majority of the position, meaning 2 to 1 is being hit, then I can start moving my stop towards break even. Because if I don't give this thing enough wiggle room and it's just rotating around the area and I see 10, 15 points of green, it's probably going to take me out of break even and then go. So if you're going to move stops before you even take profits, you want to have a certain category of qualification to tell you, okay, now it's time to move stops, and create that as a hard set rule that you have to follow with every trade. The other factor is partials out or full out. Partials out or full out is the idea that if you have multiple lots, are you taking bits and pieces out as you're seeing profit? Are you scaling out of the position? Again, it's very divided. A lot of people say, okay, I'm just going to take the full thing out. I'm not going to take any partials because that's going to kind of screw with my risk to reward. Other people like taking partials. I personally like taking partials, meaning that about 60 to 70% of the position is going to be taken out at that first take profit, and then I can play with it because that's going to be my general target, right? A lot of people might say, okay, if that's your general target, why not take the full thing out? Because there might be new information that comes into the market that allows me to see that potential expand, but I know that I don't want to gamble and roll the dice to hope that that potential expands with the full size. So I think that it depends on the trader. You want to experiment with both. You want to have an understanding about both and see which one makes more sense and which style makes more sense to you. Because I don't think that there's necessarily one right answer, right? A lot of people might be very hurt if they leave a lot on the table, right? While others don't want to take losses or break even. So you got to figure out which one you are realistically. So we've talked about risk to reward, right? We've talked about targets, but we haven't talked about ranking setups. You often heard me talk about B, A, C setups. A+ setups are the main setups that I like to trade, right? The pullbacks, they're based on distributions. The A+ setups are going to be predominantly based on the large distributions that we have. So the overall gray profile over here, where these areas are, my A+ setups are based on those. Everything outside of those and with order flow is a B or C setup. I think it's very important that traders rank these because it has to do with your execution, because you're going to size them differently. A+ setups are full size, B setups are less size, C setups even less size. B setups might be even tighter risk, tighter stops, and A setups might be normal stops. You want to be able to rank your trades and understand how you can actually divide them, because that's going to affect your risk management as well as your execution even, right? So that's a very important aspect. It prevents people from over trading as well, to really qualify what it is that you're looking at. The other factor is building the optimal A+ setup. For me, walking through a hypothetical example, we saw that long from yesterday. We can take a look at some of these trades and rank them from yesterday. Number one, it has to meet all the criteria, meaning that we're using this major distribution over here. We have 2 levels. So if we drop under that 560, 550, realistically the sell side, that's going to be the A+ setup. With delta that comes in, with the order flow, and with the footprint that we saw earlier on in the video. So that's going to be the ideal A+ setup. Now, it's realistically an A+ setup upon entry, but the exit is what really makes it an A+ setup in a lot of these cases. So C setups, they're very forceful. I want to steer clear of them. B setups are okay with lower size, with order flow that comes in. So if I rank this and I say, okay, realistically on today's session, there was only one real A+ setup that I had, but was it on the exit? This is the expansion back under that 560 over here, and I'm trying to sell around 550, 560 based on all the sell side that came in. We saw in the footprint that there's some heavy sell side that comes in, so I pulled the trigger. It drops down very quickly, about 30 points in my direction. I'm not quick enough to start taking some profits because this is going to be a major target based on that delta. So I say, you know what, the risk management to move my stop at that break even because it snapped back so quickly, that's a decision I made that may have been the wrong one. Instead of letting this thing play out, and we could have avoided some of these B-level setups that we were fighting against the market. So we want to execute with discipline, right? Even though it's a green day, it was a battle, and sometimes trades are like this, right? So to wrap this up, let's review some of these common mistakes. Next time we're going to be talking more about the journaling process, and we have maybe 1 or 2 videos left of this free futures course here on YouTube. So some of the common mistakes that people make when it comes to execution. Moving your stop further and further away. This is a huge no-no. We're not having a stop at all. Make sure you always have a stop and never move it away from its original intended position. You only move stops towards your entry, not away from it. Oversizing because the setup either feels really good or you're trying to fight back from a loss. Never oversize more than your risk management allows you. You're going to feel the burn and you're going to make a lot of mistakes oversizing. You get very emotional because it's not size that you're used to. The other factor is focusing too much on entries and neglecting exits. As we saw throughout this video, they're equally important and you need to understand exits before you even enter. And 2 final mistakes that I think traders should really wrap their heads around. Revenge trading after a loss, right? Remember, we have our setups and we rank them accordingly for a reason, and ignoring your daily loss limits. This is all about trade management. So let's wrap this up and review some of the takeaways. Execution. It's following your process, not chasing perfection. Trades are not going to be perfect. Look at this day over here. I'm still up about $1,500 on the day, but look at the execution, look at the trades. They don't look picture perfect, but the execution was pretty solid because I'm getting out at appropriate times with some okay entries realistically. Risk management is survival. No risk management, there's no trading career. Let's face it. We want to also understand that it's not all about P&L, right? Execution is about execution quality, following a process, and being able to create this repeatable process by ranking your setups, understanding where you enter, where you exit, and not focusing on the P&L. You're process driven. That's the way that your execution is actually going to get better. So if you have any more questions, let us know down below. We're excited to wrap this up in the coming videos. And if you want to learn more about it, check out community.tradeproacademy.com, our free open Discord, and you can get our free PDF down below. Don't forget to join our next webinar. It's going to be coming out very soon, and I'll see you guys all in the next video.